tension may be the defining collective condition of our entry into the AI era. And this isn't just a subjective feeling, it's a measurable, systemic outcome. AI's ability to augment productivity and replace tasks at scale is simultaneously driving two parallel forces: an exponential rise in production and decision-making efficiency, and a dramatic compression of the cycles in which technology and business models evolve. This places both individuals and organizations under the same structural constraint. To maintain any semblance of relative productivity, they must process higher density information and deliver outputs in shorter timeframes, while the value of existing assets, professional skills, job roles, fixed capital, business models, accelerates in depreciation with each new AI iteration. Everyone, from individuals to enterprises, faces constant pressure to reinvent themselves. Broadly speaking, we have entered a social operating environment defined by higher acceleration and tighter convergence. But this pressure is not evenly distributed. As the saying goes, the bigger the wave, the more prized the catch. A small number of companies with first-mover advantages in technology and capacity are currently reaping extraordinary returns from the demand surge in AI. Yet embedded within those returns are ever more demanding requirements for continuous investment and exposure to elevated risks. Roadmaps must iterate on shorter cycles, capital expenditures must align with the competitive pace of downstream AI model development. Supply chains must be restructured under the constraints of geopolitical realities. What were once considered reliable structural advantages for core suppliers have become the starting point for an arms race in capacity, a shift in customer bargaining power, and relentless pressure to redefine their position in the value chain. Even the companies most directly and visibly benefiting from this wave of AI capital expenditure are not exempt. In fact, being at the front of demand may mean bearing the greatest structural burdens. SK Hynix is precisely that kind of company. The NUMBRS in Q1 2026, SK Hynix reported revenue of 52.6 trillion Korean won, approximately $34.5 billion, up 198% year-over-year and 60% quarter-over-quarter. Operating profit came in at 37.6 trillion won, up 96% quarter-over-quarter and a staggering 405% year-over-year. Operating margin hit a record high of 72%, with EBITDA margin at 79%. Driven by its technological lead in high-bandwidth memory, or HBM, SK Hynix is currently one of the biggest beneficiaries in the AI memory space. But maintaining that lead requires the company to reinvest at a pace far exceeding the historical industry average, pouring resources into HBM generational transitions, advanced process scaling, and deepening customer lock-in, just to keep pace with, or remain marginally ahead of, the broader rhythm of AI development. When you break down the underlying commercial dynamics, you start to see that SK Hynix's first-mover advantage has not effectively translated into durable business control or a sustainable valuation premium. The reality is that high returns, high capital consumption, high customer concentration, erosion of pricing power, technical leadership, and share dilution are all acting on this company simultaneously. If AI capital expenditure growth slows or the industry enters a down cycle, these pressures will dramatically amplify earnings volatility and valuation risk. This article will focus on SK Hynix's structural contradictions and explore the kind of systemic trap that even the leaders of the AI era may find impossible to escape. Part 1. The HBM Profit Trap. The more you earn, the more you must spend. Management has repeatedly emphasized across earnings calls that HBM is the primary driver of the company's exceptional margins, so let's first try to put some shape around what the HBM business actually looks like in profit terms. According to Counterpoint Research, HBM accounted for roughly 40% of SK Hynix's Q1 2026 revenue. Over the same period, Samsung's DS division, Micron, and CXMT posted operating margins in the range of 65% to 70%, driven primarily by DRAM and NAND. From this, we can roughly estimate SK Hynix's HBM operating margin at somewhere between 75% and 83%, approximately 10 percentage points above standard DRAM. Because a single HBM unit requires stacking multiple DRAM dies, its revenue and profit per unit are significantly higher than standard DRAM. In an industry defined by cyclicality and scale, A product line that generates not only higher revenue but operating margins 10 points above the industry average is a genuine differentiator that IT reduces a company's exposure to cyclical swings and continuously expands market share. That is precisely why SK Hynix has committed itself so fully to the identity of a full-stack AI memory provider. But here's the catch: high HBM margins do not automatically translate into higher free cash flow. The more profitable HBM becomes, the more SK Hynix must do to stay at the top. Once a next-generation product roadmap is locked in, a cascade of reinvestment in next-node processes, stacking architectures, and advanced packaging becomes unavoidable. All of it is necessary just to protect those margins. This is fundamentally different from standard DRAM. GDEC specifications for conventional DRAM have broad applicability and long shelf lives, 5 years or more, enabling meaningful economies of scale. Fixed assets can be amortized over extended product cycles. HBM, by contrast, is highly customized. HBM suppliers must tailor their products to the specific requirements of chip designers like Nvidia and AMD. Generational cycles are compressed to just 1 to 2 years. Amortization pressure on fixed assets is correspondingly severe. This means HBM suppliers have no choice but to rely on high average selling prices and deep customer relationships to offset the product's inherent weakness in scale economics. At present, SK Hynix's business is growing rapidly. Its HBM technology remains ahead of the competition. Operating margins are at historical highs. Its 2026 HBM capacity has essentially been fully reserved by Nvidia's next-generation Rubin platform, so the scale weakness of HBM has not yet surfaced in the financial statements, but the pressure is real, and it is accumulating dynamically. HBM generational advancement must keep pace with, or ideally stay just ahead of, the iteration cycle of AI chips and downstream model developers. This means SK Hynix must deliver near-final engineering samples to Nvidia before tape-out, enabling chip design, validation, and system integration. Volume production ramp must also precede GPU launches. Any delay ripples across the entire AI compute roadmap. This compels SK Hynix to continuously and massively reinvest in fixed assets. The scale economics of each new generation are structurally undermined if average selling prices fluctuate or customer relationships weaken. The combination of poor scale leverage and front-loaded depreciation can rapidly reshape the company's profit structure. This is the HBM Profit Trap. To maintain high margins and market position, suppliers must invest heavily to stay ahead, and that investment must come earlier and at greater frequency than the capital cycles of traditional memory. SK Hynix's 2025 capital expenditure was 27.5 trillion won, representing about 28.3% of revenue. For 2026, capex is expected to increase substantially to over 40 trillion won, roughly 35% of revenue. More than half of that will go directly toward equipment purchases, lithography systems, advanced packaging tools for through-silicon via processes, and so on. The focus areas include expanding domestic AI memory advanced packaging facilities in Korea, as well as the Yongjin Semiconductor Cluster and the Cheongju M15X wafer fab, all in support of HBM capacity ramp and HBM4 readiness. This means a very large portion of SK Hynix's operating profit is being reinvested rather than converted into free cash flow or distributed as dividends. In short, the more HBM earns, the more SK Hynix must spend to hold its position and satisfy its largest customer. If demand growth slows or competition intensifies, that massive upfront investment could generate overcapacity pressure or crushing depreciation burdens, eroding future profit elasticity. This is the textbook version of the more you make, the less you actually have. At the core, SK Hynix's greatest commercial risk is this: it has tied its valuation and earnings leverage to a single dominant customer, while being trapped in a hyper-profitable cycle that demands perpetual reinvestment just to sustain itself. Standard DRAM's cyclical nature hasn't disappeared. If anything, it has intensified as capacity shifts toward HBM. And while HBM looks like a moat from the outside, it has made the company's performance more sensitive to Nvidia's procurement cadence, while consuming cash in a capacity arms race. If downstream AI capex growth decelerates, or if Nvidia continues to diversify its supplier base, the sustainability of SK Hynix's high margins will face a serious test. Part TWO, the leader's dilemma, technically ahead, structurally fragile. As the broader industry reached peak conditions, Samsung's DS division also entered a high-margin phase. Through larger-scale DRAM shipments and expanded capacity, Samsung has reclaimed the top position in global DRAM market share. SK Hynix briefly surpassed it in Q2 2025 on the strength of HBM. Samsung is now concentrating resources to accelerate its push into HBM. Objectively, Samsung's greatest structural advantage as the dominant global memory player is its dual-engine drive in both DRAM and NAND. Across capacity scale, process maturity, and cost control, Samsung maintains an overwhelming lead over second-place competitors in both segments. If Samsung focuses its resources on HBM, there is a strong probability it will progressively close the generational gap with SK Hynix. The will and capability are both present. More importantly, Nvidia has compelling strategic reasons to cultivate Samsung as its second HBM supplier and potentially bring in Micron as well. The core issue is that Nvidia's demand growth has already outpaced SK Hynix's capacity expansion, resulting in SK Hynix's entire 2026 HBM output being sold out well in advance. In a severely supply-constrained environment, Nvidia holds absolute pricing power across the supply chain. As Samsung's HBM yields have gradually improved, Nvidia has meaningfully pushed Samsung into the second supplier role and allocated a significant portion of HBM4 orders to them. Market estimates suggest SK Hynix's share of the HBM4 platform will fall from near monopoly status to somewhere in the 60% to 70% range. This signals that Nvidia is actively and systematically diluting SK Hynix's exclusive position, introducing second and third suppliers to reduce supply chain risk and reinforce its own dominance over the entire ecosystem. For SK Hynix, this creates a classic leader's dilemma. On one side, SK Hynix must prioritize fulfilling Nvidia's massive orders, which leaves its HBM capacity nearly fully locked up. It becomes structurally difficult to diversify the customer base toward custom ASIC designers like Google or Microsoft, or to meaningfully reduce customer concentration. If Nvidia's procurement pace or specification requirements shift, SK Hynix's earnings will be directly and immediately affected. On the other side, if SK Hynix tries to pursue other customers through aggressive capacity expansion or pricing strategy, it must invest more in customized development and reallocate capacity. This would further deepen HBM scale weakness and compress marginal profitability. In the current high-margin environment, any action that affects utilization rates or capacity efficiency could cause a meaningful decline in overall margins. The deeper problem is that this share dilution is structural, not cyclical. As long as Nvidia sustains its supplier diversification strategy and Samsung maintains its aggressive pursuit, SK Hynix will struggle to recapture its former share and pricing premium. Whatever moat its technology leadership provides will be steadily eroded by single customer dependency and intensifying peer competition. In plain terms, SK Hynix currently faces a binary choice: continue prioritizing its largest customer to protect short to medium-term margins, or accept short-term profit dilution to diversify the customer base and reduce long-term risk. Either path amplifies the structural fragility of its HBM business. This is the somewhat awkward position SK Hynix now occupies. Despite maintaining a genuine technology edge in the most profitable segment of the market, it cannot prevent the systematic dilution of its market share. This dynamic, leading but increasingly passive, is another core contradiction in its commercial logic. If Nvidia continues to expand Samsung's, or even Micron's, share across HBM4 and future platforms, SK Hynix's pricing power and long-term premium will weaken further, directly hitting earnings elasticity and positioning the company in an increasingly passive role in any negotiation with downstream customers. Part 3. Geopolitics and Regional Imbalance, from bipolar balance to unipolar. Beyond these dynamics, SK Hynix's regional revenue structure has undergone a significant shift over the past several years, one that makes it more vulnerable to regional structural risk in a down cycle. Based on the company's historical revenue data by region, China's share of revenue fell continuously from around 30% in 2021 to approximately 20% in 2025, a cumulative decline of more than 10 percentage points. Meanwhile, the United States climbed from roughly 40% in 2021 to nearly 70% in 2025. The company's revenue profile now shows pronounced regional imbalance and dangerous concentration. This shift is the combined result of geopolitical constraints and production layout decisions. SK Hynix's Wuxi facility in China still accounts for 30% to 40% of total DRAM production capacity and remains a critical manufacturing base. But due to geopolitical dynamics and export controls, access to advanced process equipment has been restricted, and the Wuxi plant's upgrade trajectory on leading-edge nodes like 1B and 1C has fallen noticeably behind the Korean domestic production lines. This means that at moments of global supply chain tension, the company simultaneously faces geopolitical risk and loses the ability to fully leverage China's enormous domestic demand. A longer-term structural pressure comes from China's domestic memory industry catching up fast. CXMT, China's leading domestic DRAM manufacturer, has shown remarkable momentum in 2026, with revenues reportedly growing more than 7 times year-over-year, net margins approaching 65%, and global DRAM market share potentially reaching close to 10%. Domestic adoption rates in server and PC segments have quickly surpassed 30%, directly compressing SK Hynix's traditional DRAM business. In the current upcycle, domestic Chinese players like CXMT are rapidly taking share in mature node and mid to low-end markets, backed by capacity expansion and policy support. This creates a dual squeeze for SK Hynix. First, China's importance as a major traditional market continues to fade, and geopolitical risk can amplify utilization volatility and supply chain disruptions at any moment. Second, when the industry eventually turns down, domestic Chinese substitution will intensify commodity DRAM supply-demand imbalances and accelerate price competition. SK Hynix is attempting to hedge some of this risk through U.S. capacity expansion, most notably its advanced packaging facility in Indiana. But this also pushes up total capital expenditure and operational complexity. Moving the regional center of gravity westward will inevitably bring higher cost pressure. The capital required to build and operate US-based facilities is enormous, and unit production costs there will almost certainly exceed those in Korea or China given local labor, energy, and regulatory environments. If average selling prices undergo any structural long-term decline, margins will be squeezed from below. In the end, the geopolitical and regional risks SK Hynix faces today are not short-term disruptions. They are long-term structural challenges that come with the US-China tech decoupling and the global supply chain reconfiguration. In capturing the benefits of this US tech cycle and AI boom, the company is simultaneously losing deep participation in China, the world's largest end consumer market. SK Hynix has little room to maneuver here. And this regional imbalance will further amplify the company's fragility through any industry cycle. Conclusion. A self-reinforcing pressure. LOOP traditional memory is a highly cyclical industry. SK Hynix's current business structure, heavily skewed toward HBM and highly dependent on the US market, significantly reduces its ability to withstand cyclical swings. With so much capacity and capital directed toward HBM, its traditional DRAM and NAND businesses can no longer provide adequate cushion or cash flow support during a downturn. The result is a triple convergence of risk: core production capacity concentrated in Korea, revenue overwhelmingly dependent on the US market, and a severe structural imbalance between HBM and conventional memory. When an industry cycle turns, SK Hynix may face earnings volatility and margin pressure far exceeding anything it has experienced before. Taken together, behind SK Hynix's current high profits lies a structural knot that compounds and reinforces itself layer by layer. The company must continuously reinvest to maintain its generational lead in HBM and hold its position as Nvidia's core supplier, but technical leadership is no longer Nvidia's only criterion when evaluating suppliers. What Nvidia needs most is sufficient capacity, better cost efficiency, faster and more frequent iteration, and a secure, controllable supply chain. Supplier diversification is a foregone conclusion, and SK Hynix's share is being systematically diluted. At the same time, SK Hynix's revenue structure is becoming ever more concentrated in the US market, while its traditional DRAM business faces sustained long-term competitive pressure from Chinese domestic manufacturers, which only increases its commercial fragility. This means that in order to sustain its current high profit levels, SK Hynix has no choice but to push hard